Today we are going to discuss the 4 pillars of maximizing exit value. This is episode 2 of the series. So why did Microsoft pay $26 billion for LinkedIn when they could have built a professional network? Because LinkedIn already had 4 specific value pillars that would have taken Microsoft a decade to replicate. Today we are going to break down the exact pillars that command premium exit valuations. Pillar number 1, defensible competitive advantage. Pillar number 1 is something generally hard to replicate. This isn't just being good at what you do, it's having structural advantages, DNA, that protect your position. Network effects like LinkedIn's user base is a great example. Proprietary data like Uber's write patterns, or switching costs like Salesforce integrated systems. So you should ask yourself, if a competitor had unlimited money and time, what would prevent them from taking your customers? That's a very big question. And the stronger you answer, the higher your exit value. Dropbox did not just build file storage, they built seamless sync technology that became deeply embedded in users' workflow. Let's talk about pillar 2, predictable revenue growth. These are revenues that the buyers will count on. It might be revenue derived from subscription models, long-term contracts, high customer retention rates. They create predictable cash flows that acquirers love. Adobe's shift from one-time software sales to Creative Cloud subscriptions increased their valuation by over 300%. And it's not just about recurring revenue, it's about growth predictability. Can you show a clear path to doubling revenue? Can you demonstrate expanding market share? Can you prove that your growth is not dependent on the heroic efforts, but on systematic, repeatable processes? Pillar number 3, you have to look at your operational leverage. The ability to grow revenue faster than cost is a prized asset. This is where software companies shine. Once you build a product, the serving the additional customers almost costs nothing. But it applies beyond tech. McDonald's created operational leverage through franchising. They collect fees from thousands of locations without operating them directly. So the key question that you need to answer, as you scale, do your margins improve or decline? Businesses with true operational leverage become more profitable as they grow, making them incredibly attractive to acquirers who see expanding returns on their investment. Pillar number 4, look at strategic synergies. How do you create strategic value beyond financial returns? When Disney bought Marvel, they were not just buying comic book sales. They were buying characters that could drive movies. They were buying merchandise and theme park attractions, and they were buying streaming content for decades. Think about how your business could amplify an acquirer's existing strength. Could you help them enter new markets? Could you cross-sell to their customer base? Could you enhance their core product offering? The more ways you multiply their existing value, the more they'll pay for yours. So these 4 pillars, having defensible advantage or moat, predictable growth, revenue growth, creating operational leverage, and strategic synergy, they separate good exits from great ones. In our final episode, we'll get tactical. I'll show you exactly how to reverse engineer your strategy to maximize these value drivers, starting from where you are today. Thank you.